Ladies and gentlemen, welcome and thank you for joining today's call. This is the rise of NATCAT events and parametric solutions. Before we begin, there are a few technical details we would like to share. Please note that all participant lines will be muted until the question and answer portion of the call. We will provide you with instructions on how to ask a verbal question at that time. You are welcome to submit written questions during the presentation, and these will be addressed during Q&A. To send a note, you can use the notes function on the lower right-hand side of your screen and address your questions to all moderators. In addition, you can adjust the presentation view on your screen by simultaneously clicking the control and the plus or minus button on your keyboard. If you do require technical assistance, you can send a note to the ATTCS operator via the notes or call our help desk at 888-796-6118. With that, I'd like to introduce to you your speakers. Clarence Wong, Chief Economist, Head ER&C Asia. Didier Bélot, Head Innovative Risk Solutions APAC, Innovative Risk Solutions. Clarence and Didier, please go ahead.
Thank you, and good afternoon, everyone. As introduced, I'm Clarence Wong from Swiss Re, based in Hong Kong. Today's topic is the rise of NATCAT event and parametric solutions. I would like to first take a few minutes to go through the latest natural catastrophe and man-made disaster losses with a particular focus on Asia. Operator, next slide, please. So there are basically 4 key observations which I will try to explain in more details later. First, losses and the number of loss events vary significantly one year from the other, but there is a clear long-term rising trend. Total economic losses from natural and man-made disaster in 2016 is the highest since 2012. Second, I think similar to the pattern we have observed in the past, both globally as well as in Asia, most of the losses came from natural catastrophes. And among them, earthquake remains a key risk, and most of the economic losses are uninsured. Third, among the different regions, Asia remains the one with the highest amount of annual economic losses in terms of fatality. While losses are high, most of these are covered by corporations and households themselves. Losses covered by insurance remain small in Asia. Next slide, please. Now in a bit more details. This chart shows the global losses. Based on Sigma's, Swiss Re's Sigma criteria, there were 327 disaster events in 2016, of which 191, or around 58%, were natural catastrophes, and then the remaining 136 events were man-made disasters. Economic losses from disaster events across the world were an estimated $175 billion in 2016. This is almost double the level in 2015 at $94 billion. But actually, this is in line with the inflation-adjusted average of the previous 10 years. So while 2016 is much higher in terms of losses compared to 2015, this is actually what we would call the norm. Out of the $170 billion losses, around 95% was due to natural catastrophe. That is $166 billion. Mostly from earthquakes, tropical cyclones, other severe storms, and floods. So you can see that while natural catastrophes account for around 58% of the total number of events, they contribute disproportionately to economic losses. Next slide, please. If we look at losses over the last 5 years, we can see that at $175 billion, global economic losses in 2016 were the highest since 2012, and is significantly higher than the $94 billion in 2015. And if we exclude the 54 billion of insurance payout, this means that there is an uninsured losses, or what we would call the protection gap, of $121 billion in 2016. I think at this point it is worthwhile to note that this insurance protection gap for disasters is actually getting bigger and bigger. If you look at a sufficiently long period of time, say the last 25 years, the rate of growth of economic losses has consistently outpaced the growth of insured losses. Or more specifically, in terms of a 10-year rolling averages, insured losses increased by 4.6% annually between 1991 and 2016, and economic losses increased by 5.6%. Next slide, please. This slide shows the major loss event in 2016 globally, and this is ranked in terms of insured losses. It is not ranked by economic losses. The largest insured loss event globally in 2016 was the earthquake in Japan in April last year, which triggered claims of around 4.9 billion or $5 billion. The second one was the Hurricane Matthew in the U.S. and the Caribbean, which resulted in insured losses of $4 billion. In total, we noticed that there were 12 disasters that triggered insurance claims of more than $1 billion in 2016, and that is significantly higher than the 6 such events in 2015. Next slide, please. This slide shows the economic losses from disasters from different regions. So you can see North America, Latin America, Europe, Africa, Asia, and Oceania. If you look specifically at Asia, we can see that as in most of the previous year, in 2016, Asia suffered higher economic losses due to natural and man-made disasters than any other region of the world. Economic losses from this disaster event is an estimated $83 billion in 2016, which is almost half of the global total. Next slide, please. If you take a look at more detail of the loss event in Asia last year, the most destructive event last year was the magnitude 7 earthquake that hit southern Japan, close to the city of Kumamoto on the 16th of April, 2016. It was the main quake of a series of notable fore and aftershocks that scratched from 14th to 19th of April. A total of 137 people died and close to 2,000 people were injured. More than 8,500 buildings were destroyed, and an estimated 160,000 buildings were damaged. Economic losses were significant, estimated to be between 25 billion to 30 billion US. And as I mentioned earlier, of which around $5 billion were insured. At the same time, there were also a lot of other major natural catastrophes in the region. For example, in 2016, China suffered many damaging floods. The most devastating is along the Yangtze River Basin in July. As many as 11 provinces in China were affected by these floodings. Economic losses were estimated as $22 billion. However, because of the no insurance penetration, insured losses from this event were only $0.4 billion, only a small fraction of the total economic losses. There were also many other loss events, for example, heat wave in India, monsoon flooding in India, and also in Nepal, and also the earthquake in Kaohsiung in Taiwan in February 6th of 2016. Next slide, please. I think that the key message here from this different loss event is Asia typically will feature the highest number of loss events or actual economic losses from both natural disasters and also man-made catastrophes. However, most of these losses were not covered by insurance payout. In this table, you can see that in 2016, for example, out of the $83 billion of economic losses in Asia, only $8.8 billion were covered by insurance. This ratio at around 10% is much lower than the 50% average observed in North America or Europe, or is lower than the global average of 30%. So in summary, we observed that there is an increasing trend of losses from natural disasters over the past decades. At the same time, Asia has consistently remained the region that is most affected by these catastrophe events. But here in Asia, it is also the region with the highest so-called insurance protection gap. As a result, I think it is imperative that we should look into different ways, including the use of innovative solutions to help to close the gap. At this point, I would like to hand over to my colleagues, Didier and Dominic, to talk about what we can do to better prepare for natural and man-made disasters. Thank you.
Brilliant. Thanks, Clarence, for those insights. We'll share a link with everyone regarding the new Sigma that's recently been launched, which provides a lot of that information and statistics. I'm joined now with Didier Bélot, my colleague here. My name's Dominic Meller. I'm VP of Communications for Swiss Re Corporate Solutions. And we thought it would be a bit more fun for this part of the presentation or the webinar to actually run a question and answer session. So I'll be asking the questions with Didier replying, and hopefully that gets everyone's thoughts going around the types of questions you'd like to pose following. But please, as the operator said, do use the different tools that are available to ask your questions as we go through. So without further ado, Didier, we've heard about the economic losses and the protection gap from NATCAT and adverse weather, but please could you explain how these events are impacting corporations?
Yeah, thanks, Clarence, and thank you very much, Dom. You know, there are many risk reports available out there, being the one published by the WEF or the one published by the broker and advisors in insurance and risk management more broadly. If they have one thing in common, is they all constantly rank extreme weather as one of the key risks that businesses and communities sustain. There's hardly any business, to our view, that is not exposed to some kind of natural catastrophe or weather-related peril. Now, let's think about the most obvious ones. You know, corporations whose assets are located in natural catastrophe-prone areas. What they need is asset protection and balance sheet protection overall. If you're looking at our region, which is Asia Pacific, there are many examples of such areas of key concentrations when it comes to what we, in the insurance jargon, are calling key NATCAT scenarios. And, you know, I'm thinking about earthquake Japan, Philippines, hurricane, Thai flood, and so on and so forth. But maybe to build up on what my colleague Clarence presented earlier, APAC, if you look at it from a global perspective, is particularly exposed and vulnerable to disasters. And operator, if you could go to the next slide. What we've done here is we took a few screenshots from our tool, the CatNet tool, which is accessible to all of you, where we just wanted to show some of those NATCAT perils, on a global scale. And you can see on the first one, for instance, we're looking at historical tropical cyclone tracks from a global perspective. What you see is basically those tracks historically dating back to, for some, prior to 1890, and their associated category. So a category, to make it very simple, corresponds to a wind speed interval. So the more red it becomes and the more intense it is. Now, looking at it from a global perspective, you can see that there's a huge concentration towards, let's say, the Philippines here. So you can see the Philippines is literally out of the map. There's been so many historical tropical cyclones over the past 100 or so years that we can't even see the Philippines on the map. Of course, the other area, if you're looking at the U.S., is Gulf of Mexico. But clearly, key concentration there. Then if you can go to the next slide, please. Here, same perspective, which is global, but here looking at a different peril. We're looking at earthquake epicenters, so historical earthquake epicenters. And no surprise, what you're seeing here is the contour of what we're calling the Ring of Fire. Now, how is it relevant to Asia and Asia Pacific? Well, you can clearly see that New Zealand, Japan, Taiwan are clearly impacted by multiple earthquake occurrences historically. The next one, and that's probably one that is a bit less visible from that scale, we were trying to illustrate the flood zone here. So to get a better picture, one would have to zoom in, obviously. But you could see Thailand there with dots of blue, east of China, parts of Indonesia, and parts of Australia obviously exposed to flood. So hopefully that gives you a better picture of what Clarence was arguing earlier on, saying that APAC is particularly exposed, and also now we know it's particularly uninsured, so the gap is stronger there. Now, there's also other corporations that may not have assets located in NATCAT-prone area, but that still have an exposure. And I think to me, this is the most important category. Think about corporations whose income is highly dependent or correlated to supply or demand, which in turn can fluctuate based on the volatility of extreme weather conditions. So for instance, let's look at the Thai flood in 2011 and the impact that the Japanese auto tech industry sustained. Or another one could be an earthquake in Taiwan, leading to losses for U.S. tech firms.
Brilliant. Thanks, Didier, for that illustration. So the next question then is, what are the different solutions corporations are adopting to protect these assets and balance sheets in the face of these NATCATs and adverse weather events, understanding perhaps that traditional insurance policies offer limited coverage or in some cases no coverage for these types of events?
Thank you, Dom. And the first, I guess, encouraging sign for me is a growing awareness. So, a lot of us took part of the PARIMA conference in Manila in March this year. And extreme weather risk has been featured as a key topic out there. So that's a sign of growing awareness when the corporate risk managers community, and we see more and more of those clients integrating weather risks to their risk management framework. Because the risk management community is turning to the insurance industry not just for risk transfer, but also for consultancy and risk mitigation advice, I do believe that brokers and advisors, and I think we have a lot of them on the line today, do have a major role to play in continuing to raise awareness about extreme weather exposure and risk management strategies. Obviously, loss prevention and loss protection are two key components before even considering about risk financing and risk transfer strategies. Now, talking about risk transfer, we all know about traditional insurance solutions such as all risk policies or standalone NATCAT covers, and those are available for most perils across most regions. And, one has to consider that in today's market environment, which, we all see as being a soft cycle, those tend to be priced very competitively, which makes them very attractive if you compare them to another alternative, which may be just not insuring them at all. And that goes back to, I guess, Clarence's argument once again about the insurance gap. Let's all work in bridging that gap together. Now, when one is looking at the corporate exposure to natural catastrophes, it does make sense to expand the scope beyond pure vulnerability of physical assets and balance sheet protection, and perhaps to broader the analysis to earnings volatility as a whole. So we're moving from balance sheet to earnings volatility and understanding interdependencies, vulnerabilities from supply chain risks, for instance, is of paramount importance. This is where we identified gaps and perhaps sometimes lack of availability for a suitable solution when looking at the scope of traditional insurance policies. That's what we're calling the gap within the gap. Conventional insurance products are typically designed to cater for physical damage loss, but earnings can be affected without such condition being met. So not only we as the insurance industry should work on increasing the penetration of insurance, but we should also aim to use insurance to cover for perhaps a broader scope.
Brilliant. And perhaps we've jumped the gun. I know the slide that everyone's seeing is the definition of parametric solutions, and I guess that is to jump in the boat slightly on our next question, which is, Didier, what are parametric solutions? I mean, they address something different from the traditional insurance market, and why perhaps are they called parametric solutions?
Yeah. So, I mean, parametric solutions combine the best elements from the capital markets and insurance into one unique solutions, and mainly so, they were designed to alleviate some concern about, an insurance recovery not offsetting a loss in the same quarter. Now, to make it in more layman terms, parametric solutions are simply insurance products that depend on the measurement of an index, and we can also call them index-based products. When the index exceeds a predefined value, the payout is triggered. Now, these payouts are typically pre-agreed, and they're based on the measured intensity level. And that's why parametric insurance products are most times used to help mitigate the risk portfolio of an organization that is exposed to a particular natural catastrophe peril.
Brilliant. I think for everyone on the call that's seeing the screen there, you can also see an illustration that we put there around one of the particular variants of a parametric solutions, which is called cat in a box. So essentially a catastrophe within the box, as you can see. The red arrow highlighting the catastrophe going through the box, which is highlighted by the yellow box there. And you can see the types of step-up payments that then would be triggered from the index being red and showing that that magnitude had actually occurred and had happened as well. So hopefully that gives an illustration of perhaps how simple these solutions are. Very complex in the background and the modeling and the data that we have to produce and do here, which we have our specialists and our NATCAT experts to help us do this. But the actual reality is it's a very simple solution. So Didier, you mentioned there that the solutions are based on an index. If you just go into a bit more detail, what can be used as an index and what are the main criteria for these indices?
Thanks, Dom. Building up on the illustration that is in the slide with what we're calling the cat in the box. So here the index will be the hurricane category, and each category corresponds to a wind speed interval. So provided that the wind speed interval is measured within the box, we make a pre-agreed payout available to our client. That's really how it works. It's very simple. Now, there are several criteria for the design of an index, and to keep it within generic terms, the index has to be obviously reliable and consistent over time. It needs to be easily measured and observable, objective, transparent, and independent. I think that is very important. Now, there are various examples of triggers when it comes to parametric solutions. We saw the hurricane scale in the slide before, but you may also think about an earthquake measured on either magnitude or intensity. Wind speed, we went through that, but you could also think about measuring the wind speed from a defined wind measuring station. Weather could be defined as well, precipitation, temperature, and so on and so forth. Now, those have been in place for quite a while, and since then, we've also used indices that are not necessarily related to weather. And, if I'm looking at the agricultural sector, for instance, crop yields per hectare or region could be defined to structure an index. Now, the most important thing is the index cannot be susceptible to moral hazard. Neither the risk taker, i.e. us, nor the insured, i.e. the insured party, should have or should be able to influence the event or its reporting. And that's why, most of the time we use those index to cover what we're calling act of God type of event that neither us as a risk taker nor the insured can have an influence on.
Perfect. And before we jump into the next, we've actually had a question posed by one of the attendees to the session here. Which basically goes back to the example of the cat in the box that was showing up on the screen. And the question comes in is, can the storm track touch any part of the box, and the policy can already be triggered?
Okay. So here the trigger is very straightforward. As long or as soon as we can measure one of the wind speed triggering the structure being in the box, we make a payout available within 15 days. There's no need for loss investigation. So here really there's one condition that needs to be met. which is the qualifying wind speed, within the box. And that's why we call it cat in the box.
Brilliant, thanks. Okay, if we move on to the next slide now, what we wanted to illustrate, and Didier, I'll come to you on this one, is how are parametric solutions different from traditional or indemnity-based insurance products?
Yeah, so I think the main difference lies in the way the trigger is being structured. So as you know, when you're looking on the left-hand side, which are traditional insurance-related parameters, an insurance cover is typically triggered upon a loss or damage to a physical asset, provided that this loss is covered by the scope of the policy. When you move to a parametric or index-based cover, this is no longer about loss or damage. What you're measuring is an event occurrence, say a wind speed or a hurricane, exceeding a predefined threshold or intensity. If that intensity is a Cat 2, for instance, for a hurricane, provided it is above that intensity threshold, we pay. The second one is, what is it that we are paying? If you're thinking about insurance, it's not a pre-agreed payout. The payout is based on the actual loss sustained minus a few things, deductible, exclusions, and so on and so forth. Here, the payout will be pre-agreed. So what we're going to agree with the client is that, well, if you need, for instance, X amount of million for Hurricane Cat 2, if that happens within the box, we pay X million as pre-agreed. A lot of times, people raise the issue, and I think rightfully so, about basis risk when it comes to designing a parametric index, which is a potential lack of correlation in between the index, the payout, which is pre-agreed, and the actual loss sustained. So we will never fully eliminate the basis risk when it comes to an index-based structure, but we can limit it. We can mitigate it via structuring different type of payout, different limits, and make it a little bit more sophisticated than a simply binary trigger that either pays it all or pays nothing. So for instance, if you're looking at, hurricane, you could have a partial payout for a more benign wind speed and progressively increase your payout as the wind speed is increasing. So that's a way to limit the basis risk, in my opinion. If I'm looking at insurance, interesting enough, there's also a basis risk, and I think a lot of us forget about that. But this basis risk in any insurance policy is typically what is excluded from the policy, okay? What is not clearly specified. Deductibles, things like this, those are also basis risk where the insured can sustain a loss that will not be fully compensated by the insurance policy. Loss assessment and payments, there is actually no loss assessment. There's no loss investigation under parametric structure. The only thing that we need to measure is the intensity of the natural catastrophe that we're covering. And that's typically done by a third-party agent, neither by us nor the insured. So think about weather providers in different countries, national weather providers. Term, we can structure parametric solutions on a multi-year basis up to 5 years, okay? And the structure of it is very flexible. So a lot of times we have the requests from our clients or broking partners about, do you have a wording? We don't have such thing because each one of those structures will have an index that will be bespoke to each single client's needs and application.
Yeah. Which I guess kind of brings us on touches on the next question that we have, which is what are the key benefits of parametric solutions?
Yeah. So to me, parametric solutions can achieve things that are not possible under conventional indemnity schemes. And by indemnity schemes, I'm referring here to conventional insurance products, which are paying on the actual loss sustained. The way I look at it is parametric should be used to push the envelope of what is called insurable or what is the non-insurable. Those products can bridge gaps that you find typically in conventional insurance policies. Exclusions that can leave losses or assets uncovered. With parametric products, a structure can be put in place that will provide a quick and pre-agreed payout without any claim investigation, without any issues with sublimits or investigation into the extent of the loss. So parametric removes all subjectivity from the loss investigation process, giving the customer a certain confidence when it comes to liquidity and speediness of it. Parametric products can certainly bring claim certainty, so it makes them quite useful when you think about earnings volatility and business interruption related claims, which are typically lengthy to investigate. But they can also make risk transfer available where traditional markets offer limited solutions. And I'm here thinking about losses that are excluded or assets that would not be deemed insurable by the insurance industry.
Brilliant, thanks. I think then the final question we have here before we open up the lines is if I think we're seeing a sort of tipping point where parametric solutions are being adopted more and more by corporations. It's certainly what we're seeing within the innovative risk solutions team, yourself, Didier. But can you provide some of those real-life examples of parametrics in action?
Yeah, thanks. And if we could go to the next slide, operator, please. I won't comment into each one of them. But, Swiss Re, be it from the reinsurance side or the corporate solutions side, we do offer a host of parametric solutions for our clients. And, we've been a leader in this area for many years. One has to remember that the first significant parametric transaction was actually carried out in the 1990s. And since then, the scope of those covers, the application, and the amount of those covers being outstanding in the market has expanded considerably. So, catastrophe bonds, and we can get into that in the Q&A, first emerged in the mid-1990s in the aftermath of Hurricane Andrew and Northridge earthquake. And they were first used by insurance companies, not by corporations. They were used by insurance companies to alleviate some of the risks that they would face if a major catastrophe was to occur, which would trigger concentration risk in their book. Now, moving from the most common form and application, which is more towards the insurance industry, to now, I think, the corporate area. There's a lot of transactions out there, of course, in key natural catastrophe areas, and because we're talking about this region here, Asia Pacific, a few of them come to mind, and probably the first one is building up on the slide that we've showed early on, hurricane and Philippines. Right, so everybody who reads the news or watches the news on TV, every month you hear about a hurricane or a typhoon striking the Philippines or threatening to strike the Philippines, unfortunately. And the Philippines is heavily uninsured, so there the insurance gap is massive. Okay, there's a need for greater penetration. There's a need for natural catastrophe covers. So what we've done in the Philippines is to cover what we're calling non-insurable assets, and those assets are typically transmission and distribution assets. And everybody on the line would appreciate that those assets are very, very hard to insure. Okay, some amount of physical damage cover may be available out there, but it's very hard to find business interruption related cover. Now, if you're using a parametric cover that will be based on the wind speed and the payout that will be pre-agreed, well, by de facto, you could cover things that were previously deemed non-insurable by actually protecting against a certain wind speed. So that's one. The other one that we've seen, and actually we have a few of those in our books, are in Australia. So, Australia is characterized by different natural catastrophe exposure. But we do have another one where, a salt mine was buying insurance cover. But they did realize that actually a lot of their salt ponds was excluded actually from the scope of conventional policies. And because the salt ponds are both subject to hurricane risk and rainfall, what we did is we designed an index to cover both perils at once. So those are the two, concrete examples that come to mind, thinking about our region. But of course, there's a lot of outstanding covers out there for Japan earthquake as well.
And then maybe a final question for myself before we open the lines is, can you provide some examples of where the covers have actually been triggered?
So by being triggered,
a claims payout.
Okay, yeah. So, it's hard to comment on that, especially when it comes to corporate transactions, because most of those are subject to confidentiality agreement. However, there are a number of parametric transactions that Swiss Re closed for what we're calling public sector. And, public sector for us are municipalities and governments. And actually those transactions are in the public domain. So, anyone can go on Google and basically, look up for those transactions in the name. And some of these sovereign disaster risk transfer schemes are arranged by the World Bank and supported by Swiss Re. And two examples of payouts that come to mind. The first one for me is what we're calling the CCRIF, i.e. the Caribbean Catastrophe Risk Insurance Facility. And the payout that was made in 2016 following Hurricane Matthew that hit the Caribbean. It was reinsured by Swiss Re, and we paid out more than 29 million US of payout for Haiti, Barbados, St. Lucia, St. Vincent, and some other islands, following basically the triggering of that facility arranged by the World Banks. I think what is interesting to point out here, besides the sheer amount of payout, is also the velocity of that payout. So we made that payout available within 14 days following the event. And that goes back again to the point we made earlier that there's no need for claim investigation. We simply need to have a measurement of that hurricane injury. And similar to this one, and perhaps closer to our area and region, the Pacific Islands and Vanuatu and Cyclone Pam, where we've also made a payout under here another facility, which is called the Pacific Catastrophe Risk Assessment and Finance Initiative. So there are several of those. Obviously the idea is not necessarily to make a payout, but the idea is basically to correlate the payout with the loss that will be sustained by our insured, in which case.
Brilliant, thank you. And just before we open the lines up, operator, if you could move to the next slide, please. We will make, obviously, the recording and the slides available to those that are able to join the call. But these are some useful links that I hope that you will explore a bit further to find out more about Sigma, which Clarence kindly presented on, but also the parametric solutions. There's a lot of materials, case studies, animations, videos on parametrics, which is the second bullet point. And the CatNet tool, which Didier mentioned earlier on the call, contains a wealth of information, and that's available through the link you see on the third bullet. Also, please do feel free to email our speakers today, Didier and Clarence, who'll be able to come back to you and speak to the local teams that we have across the region to provide answers to any questions that you might have. But we'll leave it on this slide, so it gives you a chance to jot that down. As I said, we will make this available, but I'll hand back to the operator now to moderate the question and answer session.
Ladies and gentlemen, as we move to Q&A, please feel free to place yourself into the question queue by pressing #2 or #2 on your telephone keypad. You will hear a notification when your line is unmuted. At that time, please then state your name and question. If you want to send a chat question, you can use the Notes tab on the right-hand side of your screen and address your notes to all presenters.
Maybe while everyone's thinking up different questions, one that springs to mind just while Didier, you've been talking there, and we mentioned it in terms of some of the making what is potentially uninsurable insurable, but then the obvious question to me is, are these solutions perhaps a substitute for traditional covers?
Yeah, thanks, Tom. And we don't advise our clients or our broking partners to suggest to their clients that we should replace all bits of conventional insurance in place out there and replace it all with parametric solutions when it comes to NATCAT exposure, at least. In my view, parametric solutions should work as a complement, as a top-up. They should work as a bridge for those gaps that are left, perhaps exposed by conventional insurance products. And some of those gaps could be what we've mentioned before, excludents in terms of assets that would not be covered under the schedule. It could be losses that are either fully excluded or sub-limited. Why not using a pre-agreed parametric payout, provided that the cause of the loss is obviously a natural catastrophe peril. But the other one is it could also be a bridge in timing, because remember, for business interruption related claims, there's a certain complexity, which is the whole purpose of investigating a claim, I suppose. But because we do not entertain such claim investigation when it comes to parametric, maybe some of our clients could think about parametric as a cash injection as well.
Brilliant, thanks. And just while we've been answering that, there's a couple of questions that have come in, so take those now, which is, I guess that's to you, Didier. So you seem to be getting the brunt of the questions here, but can you arrange multi-location and also multi-trigger programs?
Yeah, the answer is yes. That obviously accelerates the frequency of our structure being triggered, obviously. But yes, we can. We can have several locations, several perils. I guess what is very important is that we do not have a perfect correlation between and across those locations and that same peril. But yes, we do have structures in place where we're combining, for instance, what I mentioned before, a weather-related event, say rainfall, and a hurricane, knowing that there's a correlation between those two. We could see a structure that would combine, earthquake in New Madrid with earthquake Japan, because, for instance, there's actually no correlation, and so on and so forth, and across locations, obviously, yes.
Brilliant. And the next one we've got coming in, I guess it relates to one of the example we mentioned, which was the cat in a box, which is a single trigger. And the question we've asked, is there any comment on hybrid solutions, which perhaps talk around double triggers? I don't know if you want to mention a few words on that, Didier.
So hybrid solutions are, it's perhaps worthwhile clarifying. But, besides the pure cat in a box, there are other indices or index available out there. So, if you're looking at the cat bond market, there's also industry-wide indexes. So I'm thinking about PCS, for instance, which measures the total amount of loss that a specific industry segment will sustain. Now, could we use that as an index, to trigger a parametric payout? And the answer is yes, we've done that. Perhaps the other one is what we've quickly mentioned on the agricultural space, where, of course, we could structure some weather-related hedges, but, one step further would be to take up the analysis to a yield index, where if we could get, government to provide yield information for a specific type of crop and a specific type of area, and provided that the insured that we're covering cannot fully, exert an influence on that index, well, we could use it to also design a structure on a parametric basis. Hopefully that answers the question on the hybrid solution.
Brilliant, thanks. And then just a question here, and for the benefits of the clients on the call as well, is how the question is phrased. Could you briefly share what are the basic underwriting information requirements?
I like the word basic because it's a lot more basic than what we typically need for conventional insurance based on indemnity. And the reason being is we don't underwrite the asset or the type of loss. The only thing that we do underwrite is actually the natural catastrophe. So, not to spend an awful lot of time on that, what we really need is the area that we're covering, the type of natural catastrophe, having an idea of which intensity will cause a concern for our client, and what is the desirable payout. That's really what we need. So it makes it a lot easier. There's no risk engineering needed, no risk report, no clear understanding of what are the risk protection, risk mitigation. I think all of that is actually taken into consideration when we do design the index, which is, to me, the most important step of the analysis when it comes to structuring a parametric cover, and that's what we're here for.
Mm-hmm. And I know also with a lot of conventional covers, the loss history is also viewed as well, and I think it's important, the illustration you gave earlier from the Philippines, that solution, that the assets, the distribution assets, that the pylons, the cables they had been hit before by a catastrophe, by a cyclone, and then it was still that we were able to take that risk and use it and build a parametric around it as well, and I think that's important. It doesn't matter if there's a loss history, and sometimes, from what I've heard, that can be potentially a good thing. It means that risk management measures have potentially been put in place, and so it's perhaps a better risk as well, and so we're not afraid to shy away from where the assets have been impacted.
No, you're right. And actually, a lot of carriers are afraid of looking to those areas of key natural catastrophe exposure. But maybe back to the loss exposure. So first and foremost, it triggers a reaction and a growing awareness at our client side when unfortunately they sustain a loss. But second, a lot of times when for instance, we were to design a parametric hurricane cover for one of our clients, and comes the question as to how much payout do they need for which intensity? Would that be a Cat 3, a Cat 5? Would that be 5 or 10 million? And that's very hard to answer. The long and tedious process will be to go through a modeling agency. Okay, so think about, RMS, think about AIR, which can model, the asset exposure and the vulnerability to those NATCAT and therefore advise as to how much limit they should buy for which intensity. Now, in reality, this is not a process that we entertain too often when it comes to, corporations. That's something that we do more on the reinsurance side for catastrophic bonds, but not really for parametric design for corporations. So here, loss history could be indeed a good proxy, because we could look back and say, well, when that hurricane went through, what were the losses that you had insurance for? Looking at a gap, what were your total sustained losses? What was not covered? And therefore, what we could do is use the past to basically recreate and design an index that would have worked under those circumstances. So we could have said if there were 15 million of those losses that were not insured, but that you still sustained, they were excluded or they were not covered by the insurance policy in place at that time, maybe we designed a 15 million payout that will respond to that historical wind speed. Mm-hmm. That could be one way to look at it as well.
Yeah. Okay, and a couple more questions that have come in here. One of them is specifically around Malaysia. Is there any current client for the parametric solution in Malaysia, and how is it being arranged in Malaysia?
Yeah, so obviously we cannot disclose name of our clients, but yes, indeed they are. Now, looking at Malaysia, one needs to bear in mind, the inherent NATCAT exposure there. When it comes to Malaysia, we're mainly looking into flood type of risks, and considering the agricultural sector and its importance in the Malaysian GDP, if I could say so, these are the type of clients that we're talking to.
Brilliant, thank you. And then a question before, I'm not sure how much we'll better go into, but what is the loss ratio of Swiss Re on this particular product? I guess around parametric products, perhaps for 2016 was the question.
Okay, well, we see everything. And a lot of people are also asking the question, how expensive it is. I guess, I can try and cover those two questions at once. It all depends on how likely, that natural catastrophe or weather event would basically be triggered. So if you think about a very remote NATCAT scenario, now I'll use something that really makes no sense, but think about an earthquake in Singapore. Singapore not being very exposed to earthquake at all. It will be a very, very minimum rate on line that will be purely driven by capacity. Okay. Now, if you think about earthquake in a key NATCAT area like in Japan, well, there's more likelihood that it would happen in Japan rather than, in Singapore. Therefore, the rate on line will be a lot higher. Now, moving away from natural catastrophes, which are still quite remote, i.e. you don't expect to have several in a given year, think about weather. When we do weather and we use a parametric cover, say too much rainfall or too little rainfall, depending on how you structure the index, it could be almost in the money. I.e. it could be triggered every other day or every other month. And of course, there's a price associated with it. But I guess in summary, we see everything. We see everything from a very high double-digit rate on line to something more in the point something percentage. And it all depends on the assessment of the likelihood and frequency of that natural catastrophe or weather event in that area. What our clients like about it, it's a very objective assessment. Because once again, it's all about the likelihood of the natural catastrophe or the weather. It is not about the subjective assessment of the risk quality, which makes it very different than a conventional insurance product.
Mm-hmm. Okay, thank you. And one question we've asked here around regulatory obstacles around the region for parametric solutions. Are there any?
Yeah, there could be some, because obviously the way we simplified it, I suppose, for the purpose of our call, we just say that, provided that the index is triggered, we pay the pre-agreed payout regardless of the loss. Now, when we do so, typically this is not exactly an insurance product, because an insurance product by legal requirements cannot cover more than the actual loss sustained, whereas here potentially you could have a case where the actual loss sustained, the total loss sustained will be lower than the pre-agreed payout. That's not something that we want to entertain, but that may happen, in which case that agreement will be more structured as a derivative agreement, same as your typical interest rate swap, for instance, and we can do that. That's what we call CAT swap. Now, regulation comes into play when we're trying to develop some hybrid solution, okay? Something that would mimic that approach, that parametric approach, i.e. a pre-agreed payout upon the measurement of an index, okay? But that would still be qualified as an insurance product. And here what we do is we typically add a second requirement, which is a proof of loss, So there needs to be a proof of loss following the measurement of either the natural catastrophe intensity or the weather parameter to make it work like an insurance. And then it's case by case. It's case by case because it will depend on the local regulator and the local acceptance. Now, maybe to give you some more confidence in all of that, APAC being probably one of the less mature markets when it comes to that space, Swiss Re overall has a track record in most countries. So think about China. We've done something with the Chinese government. Lately, we've done something in the Philippines. We're looking into Malaysia. Actually, we've executed something into Malaysia, India as well, and of course the obvious one, right? We do have a lot of those instruments out there in Japan, in Australia, in the more mature countries, or perhaps the more developed ones.
Brilliant, thank you. Okay, I think that concludes the different questions that we've been asked. Perhaps we'll hang on the line for a minute or so more in case there's some further questions now.
Just a reminder for the audience, if you do have a verbal question, you can press #2 or #2 on your telephone keypad, and as well as send a note or chat questions using the Notes tab on the right-hand side of your screen.
Okay, so perhaps we'll conclude the webinar there. I hope everyone's been able to jot down the different links that we put up on the screen, but also the email addresses of our speakers as well. And please do feel free to reach out to Didier after the webinar, following days, weeks, if you have questions about these types of solutions. As you heard, there's a lot of different flavors to the parametric solutions, from the basic pure parametric on a single trigger to double trigger, and then finally into the derivatives that Didier was speaking to. And I guess that's on a case-by-case basis. And we're absolutely keen to have a dialogue with clients, brokers, to explore these different solutions and how we can be helpful and put good programs in place. So with that, I'll hand back to the operator to conclude the call. Thank you very much.
Thank you for joining today's conference. The call is now concluded, and you may disconnect.